Hello, I'm John Ward on behalf of the Physical Gold Fund. We're delighted to welcome you to our first webinar with Jim Rickards in the series we're calling The Gold Chronicles. Jim is an investment banker and investment advisor based in New York, and he also serves on the Investment Advisory Committee for the Physical Gold Fund. Jim is the author of the New York Times bestseller, Currency Wars, The Making of the Next Global Crisis. And most recently, he's the author of The Death of Money, The Coming Collapse of the International Monetary System, also a New York Times bestseller. Hello, Jim, and welcome.
Hi, John. Great to be with you and great to be with our webcast listeners also.
We also have with us Alex Stanzik of the Physical Gold Fund. Hello, Alex.
Hi, John.
Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question. And as time allows, we'll certainly do our best to respond to you. So, Jim, in these webinars, we're going to address some pressing current questions that impact the gold market, but also, when we can, take a step back and look at some of the fundamental issues. And let me start with a hot topic, the price of gold. For quite a while, you've been calling for a dramatic rise in the valuation of gold sometime in the relatively near future. Meanwhile, the yellow metal has taken quite a hammering, especially in recent weeks, and now we have commentators calling for gold at $900 and even $800 an ounce. I'm aware this is a topic we've addressed in our recorded podcast, but could we touch on it again here today?
Sure, be glad to, John. And yeah, I mean, we all know the price action. We can all read a tape. And I will say there's nothing that has fundamentally altered my view. So what I've expressed before, that we are getting closer by the day to some kind of collapse of the international monetary system. That doesn't mean tomorrow morning, but sooner than later. The horizon is, several years. It's not a 10-year forecast. Could it be 5 years? Maybe. Could it be 1 year? Yes. So, somewhere in that time frame. We can never know the exact time, but sooner than later, certainly soon enough to begin taking action today. So that kind of international monetary crisis is coming. It doesn't mean that you automatically go to a gold standard, but going to a gold standard is one of the possible outcomes. It may be necessary to restore confidence. And if you do that, you have to say, well, what is the dollar price of gold? If you're going to have a gold standard, you have to set a dollar price. And one of the great economic blunders of certainly the 20th century, maybe all time, was when countries went back to a gold standard in the 1920s at the wrong price. They had printed so much money in World War I that to go back to the gold standard at, let's call it the old price, the pre-World War I price, was disastrously deflationary. They had to kind of recognize the fact that they had printed the money and should have come with a much higher price, but they didn't. So the math is not that difficult. To have a gold standard today that was non-deflationary, you'd have to have a price at the low end, probably around $10,000 an ounce. At the high end, perhaps $45,000 an ounce. I'm not predicting or expecting $45,000 gold, but I am expecting $10,000 gold based on this return to some kind of gold standard to restore confidence. So nothing has changed to all of that forecast. In other words, if you say, well, governments around the world are taking steps to avoid the monetary collapse, then yes, I might change the forecast. I would say, well, we're going to steer away from the disaster because we're enacting smart policy. But in fact, I see the opposite. I don't see the smart policies. Therefore, I see the collapse coming, and arriving at a much higher dollar price for gold in order to restore confidence is a very straightforward exercise. So these are not numbers I pull out of the hat, or they're not numbers I make up to get provocative headlines. To me, it's just very straightforward analysis. Having said that, yes, gold has been volatile. It's not a lot of fun if you're a gold investor, you have gold, and you're watching the dollar price go down. No one enjoys that. But when I see that, I don't get too euphoric when the dollar price goes up. I don't get too depressed when the dollar price goes down. To me, it's just market information. It tells me something. So when I see the dollar price going down, I certainly don't sell gold. Occasionally I buy more because I like the price. I think this is probably a good entry point. But I just spent a couple days down in the Dominican Republic with Jim Rogers. I'm sure a lot of our listeners know Jim Rogers, very celebrated investor, commodities trader, one of the co-founders of the Quantum Fund, along with his then partner George Soros. Jim Rogers and George Soros went their separate ways, but Jim has had a very successful career as an investor. He, like me, he owns gold. He's sitting on his gold. He's not selling any. And he said he'll buy more. But he made a very interesting point. He said, no commodity has ever rallied to its kind of ultimate potential or its, its end level without a 50% retracement. He's been around in all markets. It's not just gold. It's, copper, wheat, corn, oil, you name it, stocks for that matter. He said 50% retracements in commodities land are not unusual. So if you had an all-time peak of about $1,900 an ounce for gold, a 50% retracement would be $950. So, 1,900 minus 950, I think that gets you down to 950 if I'm not mistaken. They call it 1,000 for a round number. I like the entry point right here where gold's about 1,200, give or take. But Jim says it wouldn't shock him to see gold go to 1,000, but at that point, you do have a 50% retracement. He would kind of back up the truck and load up there. So he's keeping the gold he's got, as am I. He said he's a buyer at 1,000. I'm not Jim Rogers. I'm not the commodity trader he is. I kind of like it where it is. But again, this kind of price action, this kind of volatility is not unusual. But the long-term forecast has not changed simply because the fundamentals haven't changed and the math hasn't changed. So I'm sticking to the much higher forecast. I recognize the recent price action, but we're certainly a lot closer to the bottom than the top, and we can expect a turnaround sooner than later.
Well, another topical question here, Jim. Here in the United States, we've just had our midterm elections, and the Republican Party has strengthened its grip on the House of Representatives and taken control of the Senate. Does this have any bearing on the dollar's present rise in the currency markets, and therefore, if the dollar is rising, perhaps on the lower price of gold?
I don't think it does, John. I mean, you're right about the price action. We do see the dollar going up. We do see the dollar price of gold going down. Those two things are linked. They're just inverse of each other. To me, a lower gold price just means a strong dollar. And likewise, the thing that will cause the dollar price of gold to go much higher is a weak dollar. So the dollar-gold relationship is exactly what you described. But I don't think the elections had very much to do with it, and here's why. Obviously, politically, it's a big deal, and if you're Harry Reid and you're not the majority leader, that's not a lot of fun. I'm sure Mitch McConnell is happy to be the new majority leader. But the question is, will this lead to cooperation between the White House and the Congress on important structural issues? Because as you know, in some of our past podcasts and some of my writings, I've made the point that we're in a global depression. We're not in a cyclical recovery. I mean, technically, the economy's been in a technical recovery since the end of 2009, but I don't view this as the normal kind of post-World War II cyclical recovery. What we are is in a sustained period of below-trend growth. If your trend is, or your potential is, say, 3.5%, your short-run potential is 5 or 6%, and you're actually growing around 1 or 2, which we are, that fits John Maynard Keynes' definition of a depression. And the definition is not, collapsing or continuously declining GDP. You can have rising GDP in a depression. It just means that it's rising well below your potential growth. So, again, if you could grow at 3.5 and you're actually growing at 2 for a long period of time, that's a depression. That's what we're in today. And so depressions are structural. They're not cyclical. In other words, there's nothing monetary policy can do about a depression. In a normal business cycle or credit cycle, yes, monetary policy easing and tightening can have a role, can help the economy or cool it down, as the case may be, but not when you're in a depression. Depressions are structural, and you need structural solutions. Structural solutions are things that come from the Congress and the White House. They're things like, fiscal policy, tax rates, capital gains taxation, global taxation, Fair Labor Standards Act, minimum wage, Keystone Pipeline, Obamacare, environmental regulation. Those are the structural handicaps that the economy is suffering under, and the economy is not going to get better until we do some smart structural changes. Now, with a Republican Congress that wants to lean in that direction and a White House that can read the tea leaves, you might say, well, gee, isn't there the potential for some cooperation and some smart policy that might get real growth moving, and that could impact the dollar price of gold? And my answer is, well, the potential's there, but will it be realized? In other words, the president has a choice. The president can look at Republican electoral victories in the 2014 midterm election and say, okay, I get it, I got the message, voters are unhappy with the course we're on, they want to change, they put Republicans in charge of the Congress to sort of cause the change, so I'm going to get the message, heed the wake-up call and start to work with them. And by the way, this is exactly what Bill Clinton did in 1994. The first 2 years of the Clinton administration, from 92 to 94, he was pursuing a very progressive agenda. He had what we called Hillary Care at the time. It was Hillary Clinton's version of Obamacare, and that was his big initiative, and he did a few other things by executive order. He looked a little bit like a progressive Obama, and then what actually happened was he lost the midterms. Well, Clinton got the message. Clinton read the memo, sat down with Newt Gingrich, and they did some very good stuff over the next 6 years. And the U.S. had a very strong economy throughout the 1990s. You look at what Clinton actually did. I always call him one of our great Republican presidents. I mean, Clinton's three big accomplishments were balanced budget, free trade, and the end of welfare. If that's not a Republican platform, I don't know what is. So Clinton's a guy who started out on a progressive path, had a wake-up call in a midterm election, and then did a pivot and worked with Republicans to get some good things done. Now, Obama is no Clinton. Obama's on a progressive path, has been for 6 years. He also took a setback in the midterm election, but he's not getting the message. He seems to be doubling down on the confrontation, obviously with his threat to issue amnesty, which the Republican Congress does not want. And now it looks like the approval of the Keystone Pipeline, that would be one of the structural changes that I'm talking about. It looks like that's going to go through in a matter of days. It was passed by the House today, probably teed up for Senate passage, and the indication is the president will veto it. So there are, a couple of things. By the way, I'm not here to debate the pros and cons of all those things. I know you can get bogged down in immigration debate and Keystone Pipeline debate. I'm not here to debate them. I'm just here to say that those are the structural changes I'm talking about. What we're seeing is not cooperation but confrontation. Therefore, I expect just more dysfunction, more fighting between the White House and the Congress. The president really defying the Republican Congress, poking a stick in their eye. Again, you can debate the politics all day long, but as an economic analyst, to me that's just more dysfunction. Therefore, no structural changes. Therefore, no changes in the depression we're in, and we'll continue to have this tug of war between inflation and deflation. By the way, going back to the first question, John, what the price action and gold tells me, among other things, is that deflation is winning. Since my first book, Currency Wars, I've described this inflation-deflation dynamic as a tug of war between two very powerful forces, and no team has conquered the other team yet. We haven't gone into severe 1930s style deflation, nor have we gone into severe late 1970s style borderline hyperinflation. We don't have either one, but the tug of war continues. So right now deflation seems to be winning, but what that tells me is that the Fed's nowhere close to raising interest rates. They may even come back late next year or early 2016 with QE4. So the stars are still aligned, if you will, for inflation, which at the end of the day, if the Fed wants it, they'll get it, even if it takes years, and we all know what that will do to the price of gold. So elections are interesting, but I don't see cooperation. I see confrontation. And that tells me more of the same from a policy perspective and more money printing at the end of the day by the Federal Reserve.
Well, now, Jim, I'd like to shift the ground here a bit. I'd like to ask you briefly about a bit of a stir you caused with a recent article you wrote. The title, as I recall, was In the Year 2024. And some people have read you as predicting worldwide gold confiscation. Can you tell us what you actually wrote and maybe elaborate a little bit on this article?
Sure. I did write an article called In the Year 2024. This is something I write. I have a newsletter. It's called Rickards Strategic Intelligence. It comes out monthly. My publisher is Agora Financial down in Baltimore, so I'm enjoying writing the newsletter for them. This is one of the articles I wrote. But the newsletter is by subscription, so it's behind a paywall. You have to, pretty reasonably priced, by the way, but you have to kind of sign up for that. But occasionally some of the articles are taken out and put on the web in ways that everyone can see them, and this was one of those articles. I was trying to have, it was a serious article, but I was trying to have a little fun. One of the things that's dismaying, I'm a serious financial analyst, and these are serious matters when we talk about money and gold and people's net worth. But, a little humor goes a long way. So I was trying to have a little fun with it. But what I was writing, it was not a prediction. It was not, oh, here's what's going to happen, and here's what's all the gold's going to be confiscated. I did talk about things like that, but it was really set. It was meant to be in the same vein as Franz Kafka, George Orwell, or Aldous Huxley, where you're writing about the future, but what you're really doing is writing about the present. You're using the future as a literary device to warn people about things that are going on today that they need to pay attention to. And so it's a very dystopian article. It talked about everyone having, biometric implants in their arms in order to qualify for government health care. And if you didn't have the implant, you couldn't get health care, and the implant would monitor your activity and control your thoughts, and people had to wear goggles. It was sort of almost like a Philip K. Dick science fiction piece. I think a lot of the humor was missed by some of the readers. In my first sentence, I referred to the bug that's implanted in you as an insect size. That was obviously a reference to the first line of Franz Kafka's Metamorphosis, where the protagonist woke up as an insect. I don't know, maybe we were playing over some people's heads a little bit. But the point is, if you take George Orwell's 1984 as an example, not everything George Orwell wrote about 1984 happened in the year 1984. We lived through 1984. I guess there's some 19-year-olds on the phone. Maybe they didn't, but I think most of the listeners did. But the reason George Orwell called it 1984 was because he wrote it in 1948. He just took the 4 and the 8 and flipped them around to get 84. But in 1984, he was really writing about 1948. He was warning people that some of the unpleasant dystopian neo-fascist things in his future novel were actually happening then and there in 1948. Obviously, he was thinking about Stalin and the Soviet Union. So I was doing something very similar. I called it In the Year 2024, but I was really writing about things that are happening today that investors should be concerned about. So a serious article, tried to use some literary references, tried to use a little humor, but with a serious purpose, which is to warn investors about trends. There's also, John, something called, I think a lot of listeners have heard of the self-fulfilling prophecy, where you predict something and it comes true because people believe it's going to come true and they act accordingly and they make it come true. So it's the prophecy that causes itself to happen because of adaptive behavior. But there's also something called the self-negating prophecy. It's when you make a prediction about the future, write about the future, and by providing warning, people act in inappropriate or helpful ways and make the bad thing not come true. That's sort of what I was trying to do by warning about potential bad things. Maybe we could get some positive behavior or positive policy outcomes today that would actually prevent the bad things from happening. So I actually think gold confiscation is extremely unlikely for 2 reasons. One, it's difficult to do. B, we live in a global world, much more so than in the past. So what one jurisdiction does, another jurisdiction can undo. It's a reason to possibly have gold in multiple jurisdictions. And candidly, there might be a little pushback. In 1933, when FDR confiscated the gold of the American people, there was enormous trust in government, fear about the economy, and the belief, well, the president must know best. So if the president tells us to hand over our gold, we'll hand it over. I think all those conditions have changed. I think there's a lack of trust in government, a belief that politicians do not know best, and therefore I think there'd be perhaps a lot of civil disobedience when it came to that, and that might be a reason why people wouldn't try it in the first place. But the other thing that was missed in the article is before I got to this end game, I did say that gold had gone up to $15,000 an ounce or higher, and people who were smart enough to buy it when it was $1,000 or $1,200 did quite well. And maybe if you buy it at $1,200 and it goes to $15,000, maybe you're a seller at $15,000, and you buy a farm and live happily ever after. That's not a bad trade. So we're a long way from that. But there was a lot in the article, I think, to suggest that having some portion of your investable assets in gold is a smart strategy. I know I do. I recommend it to investors, and that's absolutely the case. But I hope people do find the article and enjoy it. But it wasn't quite. It was taken literally and without a sense of irony or humor. And I think some of the critics missed the point.
Well, Jim, I'd like to step back for a minute and ask you something of a big picture question, actually in a way an elementary question about gold. And it's this: why is it that when we discuss gold, we seem to always find ourselves talking about so many other things that might seem unrelated? We find ourselves talking about the composition of the Federal Reserve, or the role of the IMF, or the crisis in Ukraine, or the true meaning of unemployment figures. And what I'm thinking is this: if I invest in land or fine art, I probably want to be aware of the general context, but I surely won't be peering into the mind of Vladimir Putin or worrying about what happens on the streets of Hong Kong. What is it about gold that demands attention to such a big canvas?
Well, John, that was your longest question, and I think I can give it the shortest answer. The reason people are fascinated by gold is because gold is money. And I don't necessarily think I have to go on at length about the fact that money is a fascinating subject, but it makes a serious point. I talk about this in Chapter 9 of my book, The Death of Money, and it's just why gold just confuses the heck out of people. I've always been able to kind of look at it in fairly straightforward terms, but it sure is difficult in a lot of conversations. But gold is money. It's a form of money. Now, look, the dollar bill is money. Bitcoin can be money. The euro is money. There's more than one kind of money in the world, and there have been times when, different kinds of money have competed for a role as the global reserve currency. In the 1920s, I would say you had three global reserve currencies: the pound sterling, the U.S. dollar, and gold. And indeed, under the gold exchange standard of the 1920s, if you looked at the balance sheet of a country, its reserve position or its central bank balance sheet, that's exactly what they had. They had the reserves in a couple different currencies and gold. So gold is just a different kind of money. And, our friend Warren Buffett always criticizes gold. He says, gold has no yield. Well, it's not supposed to. Money is not supposed to have a yield because it's the safest kind of asset. In other words, take a dollar bill out of your wallet, put it on the table or desk in front of you and look at it. Does it have a yield? No, it doesn't have a yield because it's money. Money doesn't have a yield. Now, people say, oh, I can put my money in the bank and get, half of 1% interest. Well, of course you can, but when you put your money in the bank, it's not money anymore. Now it's a certificate of deposit at a bank, and everyone says, well, that's the same thing as money. Well, I have news for you. The President of the United States and world leaders are in Australia right now, as we speak. They're in Australia at the G20 summit, and if you look at the final communique, which is coming out tomorrow, they are going to warn the world that if you have money in a bank, you are a general unsecured creditor of the bank. You are subordinate to bondholders and other secured creditors of the bank, and therefore you're just an unsecured creditor of a bank. So what people think of as money, specifically bank deposits, you're no better off than Cyprus. I mean, what if the government shuts down the ATM machines or reprograms the ATM machines to say, oh, you've got $20,000 in the bank? Well, that's fine. We're going to limit you to $300 a day for gas and groceries. That's plenty for gas and groceries. But no more. We're going to freeze your money until further notice. That's what the major governments of the world are telling people today. Today and tomorrow, as I say, they're meeting in Brisbane, Australia, in this G20 summit, and that's one of the things that's going to come out of it. So it's kind of a wake-up call. Recently the SEC enacted rules saying that they can freeze money market funds. Those were enacted last summer. Now, most people have money market funds. They think that's money. They say, well, if I need money, I can call my broker and redeem some money market fund shares, and that money will be in my bank account tomorrow. And if they have to, do a big ticket purchase or pay some bills or buy a car, buy a house, whatever, they think that's money. Well, the SEC just passed a rule saying they can freeze the money market accounts. So it's not money. There's just a lot of confusion on the subject. So the things that people think are money, such as money market funds and bank deposits, turn out to be subject to government freezes and lock-ins, so they're not really money. The thing that is money, if you had a stack of $100 bills, I would call that money. If you had some bitcoins, that's a form of money. And if you had some gold bullion, that's a form of money. But none of them have any yield, and money doesn't because it's accounting device to store wealth. It's the purest form of monetary asset. So when you think of gold, I know gold trades on commodity markets, and I know it's marketed as an investment, but to me, when you have gold, what you really have is money, and I say to investors, if you like stocks and bonds and land and fine art and all that stuff, that's fine. That might have a place in the portfolio. But if you want money, get some gold. So I think, and when you explain it that way, I think people understand it, but it's not intuitive to people because they've been told for 40 years that gold is not money. My question to the United States is if gold is so worthless, why are you hanging on to 8,000 tons? Why have you not sold an ounce practically since 1980? If gold is not money, why are the Chinese buying thousands of tons? If gold is not money, why have the Russians doubled their gold reserves in the last 5 years? When you look at what's actually going on in the world, as opposed to the kind of happy talk you get on television, it's very apparent that the world is on a shadow gold standard already, is moving back to a more formal gold standard, that gold is money that banks are acquiring at hand over fist. It's not just a commodity like wheat or corn or oil that's traded on commodity markets, and it's hard to even call it an investment because it doesn't have a yield. I mean, Warren Buffett is right about that, but my view is that's okay. It's money. Money's not supposed to have a yield, but it's the one form of wealth that isn't digital, can't be hacked, can't be frozen. If you have physical gold, you're good to go. So I think that when you strip away all the mystique and some of the propaganda and the happy talk, what you realize is that the reason gold is so fascinating is because it is the purest kind of money, and needless to say, money is fascinating.
Well, thank you, Jim. And now we do have some questions from our listeners. So here's Alex Stanzik with those questions. Over to you, Alex.
Thanks a lot, John. We have quite a few questions here, and we do have, let's see, about 30 minutes left. So we should be able to get through most of these, I'm hoping. We'll just dive into the first one here and take it from there. Jim, this question is coming from Christopher. By the way, I'm not going to say last names. I'm just going to use first names, but it's Christopher G. that's asking this question. And his question is, Jim has said he's not a fan of gold mining stocks, and why not?
Well, it's not that they don't have a place or you shouldn't buy them. It's just that it's hard for me to recommend them. And here's why. Gold is totally uniform. It's, atomic number 79. It's an element. It doesn't get much purer in terms of the uniformity and grade and so forth. I mean, gold is even superior to, oil and other commodities. There are 49 different kinds of oil around the world when you get to grades and sulfur content and viscosity and all that, but there's one and only one kind of pure gold, which we just discussed about. When you get to gold miners, they're not generic. There are excellent gold mining companies out there with good management and good prospects and good feasibility studies and solid capital structures, and there are horrible gold miners out there that are penny stocks, borderline fraudulent, incompetent, don't know what they're doing. Well, the difference is mainly management. That is to say, gold is gold, geology is geology, feasibility studies are what they are. Those things don't really differentiate gold miners. What does differentiate them is, differentiates any company, which is the management and the balance sheet and the capital structure. I can speak generically about gold, but I cannot speak generically about gold miners because I think there are good ones and there are frauds. And how do you know which is which unless you're a really good stock analyst? Now, I look at people like, John Hathaway, who runs the Tocqueville Gold Fund, and others, Doug Casey, Casey Research. There are people out there who spend their time thinking about the issues that I just raised, thinking about gold miners. That's not what I do. I'm a global macro analyst. I'm an economist. I think about gold a lot in its monetary role, but I can read a balance sheet, but I don't hold myself out as a stock picker. So I don't really like to talk about gold miners because I haven't done my homework on them. I would say that gold miners have been beaten down badly. Again, gold mining stocks are a leverage bet on gold itself. Gold is volatile, and gold miners are more volatile because of the economics of mining and fixed costs versus variable costs and some other constructs inside the balance sheet. So if you think gold's a roller coaster, try the gold miners. I would say that when something is down 90% or 95%, there are only two ways for it to go. It's either going to go to zero, in other words, the company is going to file for bankruptcy, or it should bounce back. Now, I'll leave it at that. Again, I'm not going to name names or pick stocks. I'll leave that to the listeners and investors and people who are smarter than I am when it comes to that kind of analysis. But if you can kind of be alert to the ones that are maybe heading for bankruptcy and think about the ones that maybe have gone as low as they can go, there might be some opportunities there, but I'm not going to name names or pick stocks because it's not what I do. But the short answer is miners are leveraged bet on gold, but they're not homogeneous. They're highly differentiated, and you really have to do your homework to know who's who.
Very good. Okay, the next question is from a gentleman named Jeremy A. And his question is, despite a printing press, the Bank of Japan couldn't stop deflation post-'89 in Japan. Why will it be different in the United States with the Fed and the IMF?
Well, the short answer is it may not be different. And that's a very good point. You know, I like to say it's a sad day when central banks want inflation and can't get it. There's no question that every major central bank in the world right now wants inflation, and that's not, you know, reading tea leaves. They say it. The Fed. How many times have you heard the Fed say their inflation target is 2%? You know, European Central Bank, Japan. Actually, they've all said the same thing. They've all said they have an inflation target of 2%. By the way, you shouldn't be all warm and fuzzy about 2% inflation. I mean, 2% inflation cuts the value of a dollar in half in 35 years and cuts it in half again in another 35 years. So if you take a 70-year kind of normal lifetime from birth to age 70, if you think of that as the average lifetime, even with 2% inflation, the dollar will lose 75% of its purchasing power. So that's not, 2% isn't benign. To me, I analogize 2% inflation to, you know, an 8-year-old kid who looks in his mom's wallet and sees $50 in singles, and he says, well, I know if I steal the whole $50, I'll get caught and I'll be in trouble with mom, but if I steal one or two, she won't notice. That's how the Fed steals your money a little bit at a time. So that's what 2% inflation does, but they can't even get 2%. Well, the reason for that is, again, it goes back to what I call this tug of war, and it also explains why we have not had an inflationary breakout with all the money printing, because that's the other side of the coin. I mean, the Fed actually has printed over $3 trillion in the last 5 years. I mean, that's a fact. And at the beginning of that process, there were a lot of people sounding alarms saying, oh, my goodness, if you print that much money, we're going to have inflation, and et cetera. The inflation has not shown up. It's not here. But there's a reason for that, which is money printing alone does not get you inflation. You need two things. You do need the money printing, but you also need velocity, or the turnover of money. You need people to actually go out and borrow it and spend it and invest it and use it. If you don't have that, you're not going to get the inflation. Now, the money printing has been enormous, but the velocity has been collapsing. So, you know, the simple quantity theory of money, it's money supply times velocity equals nominal GDP. I mean, that's pretty straightforward. Well, the money supply has been going up, but the velocity has been crashing. And I like to remind people that 4 trillion times zero is zero. In other words, if you have $4 trillion of money but zero velocity, you have no economy. And so therefore, the money printing has not caused inflation because it's been offset by the decline in velocity, which has barely kept nominal GDP constant. So that's how you can understand the tug of war in sort of formal, you know, mathematical or analytical space. Now, how do you change velocity? The Fed can make money supply whatever they want. They really can. But velocity is psychological. It's behavioral. You have to change people's behavior. You know, here we are. It's a Friday. You know, if I'm feeling good and I want to go out tonight and take some friends to dinner and buy drinks for everyone at the bar, that's one state of the world. Spending a lot of money. But if I decide to stay home and watch some college football and not go out, the velocity of my money is zero because I'm not spending anything. So it's psychological. There are two states of the world. And what the Fed has to do is kind of lie to us and manipulate us to try to get out and lend and spend and get the old, you know, velocity nominal GDP machine cranked up again. So to get back to Jeremy's question, that's right. Now think about what the Fed and the Bank of Japan in different ways have tried to do to get velocity moving, to change the psychology. First, cutting rates. Well, you can do that so far, but you get to zero. Then quantitative easing, which is money printing. Currency wars, which is cheapening your currency. Even when you're at zero interest rates, you can create monetary ease by cheapening your currency, which a lot of people think is to promote exports, but that's not really the reason countries do it. They do it to import inflation in the form of higher import prices. In Japan, a cheaper yen would mean they'd have to pay more for imported oil, and that inflation would feed through the Japanese supply chain. So that's how they're hoping to get inflation. In the case of the United States, remember, we have a trade deficit. We import more than we export, so a cheap dollar would lead to higher import prices. But the problem with the currency wars, of course, is that not everybody can cheapen at the same time against everybody else. That's a mathematical impossibility. So right now we're seeing a cheaper yen and a cheaper euro versus a stronger dollar. So the U.S. is saying, in effect, we think we're strong enough to import some deflation from around the world and let Japan and Europe try to get a little inflation going because they need the help more than we do. But that won't last because the U.S. economy is a lot weaker than most people expect, and I think by late next year we're going to have to go back to the cheap dollar policy, which means that at least Europe's going to have to suck it up and deal with a stronger euro. So this just goes back and forth and back and forth. So this shows the power of deflation. It shows the fact that the bag of tricks, QE1, QE2, QE3, currency wars, forward guidance, zero interest rates, Operation Twist, all of these things have failed to get inflation going, which shows you the power of deflation. So, but I guess what I would say is there are reasons why central banks cannot have deflation, why they cannot tolerate it, but nevertheless, deflation is very strong, as Jeremy points out, which makes policy very easy to predict because if deflation is powerful, and central banks have to have inflation and they're not getting it, guess what? They're going to try harder. That's why I see no interest rate increases in 2015 and possibly QE4 by the end of 2015, early 2016, which is why I still have a much higher gold price in the forecast.
Okay, very good. The next question comes from Daniel H. And his question is, in terms of liquidity for the U.S. stock market, which seems unstoppable, I happen to agree, Daniel, he's asking at what point does yen and euro weakness negate the liquidity that the Bank of Japan and the ECB are providing?
The sort of two different things going on there. One is liquidity in the U.S. stock market. A lot of that is driven by leverage. Remember, we have zero interest rates. New York Stock Exchange margin loans are at an all-time high. So the stock market, is reaching new highs, but it's doing that on narrow breadth and ultra leverage. So that's almost the definition of a bubble. It doesn't mean that it can't go on. It doesn't mean that bubbles won't get higher or lead to higher prices, but it does mean it has a bubble dynamic, which is very unstable. Now, when you get over to Japan and Europe, as I just explained in the last answer, they are cheapening their currencies to import inflation in the form of higher import prices or promote exports as a byproduct to try to get a little bit of inflation into their economies. But what that has resulted in, there's, because of the end of QE3 and because Wall Street research, which I don't agree with, by the way, but most people follow it, Wall Street research expects interest rate increases in 2015. The only debate is, will it be March or will it be June? My answer is it will be never, or at least as far as the eye can see, but that's not the consensus. The consensus is that it will be sometime in the spring or summer of next year. So if you're an investor, you're looking at Japan saying, okay, you guys are, you have zero rates and maybe you're going negative. Europe, you guys are already negative. U.S. looks like a rate increase, so I'll sell my yen, sell my euros, buy dollars, and then flood into the dollar system, and then that money has to find a home. So there's a bid for treasuries, which is one of the reasons the treasury market has rallied, and there's a bid for stocks and a strong dollar. But that whole dynamic, and I've never seen so much money around, by the way. I mean, money is not the problem. The problem, as I explained earlier, is psychology and philosophy and what economists call regime uncertainty, the unwillingness of businesses to invest because they don't know what the rules are. What's going to happen to taxes, what's going to happen to healthcare, what's going to happen to the environment, Keystone Pipeline. You go down the list, making 5-year infrastructure investments is hard enough just trying to account for normal business risks, but when you have to layer on that much policy risk and political risk on top of it, people say, I'd rather just sit on my cash and wait till, wake me when it's over kind of thing. So that's one of the drags on the economy right now. But But the short answer is there's a flood of dollar liquidity, strong dollar, but it's based on expectations of higher U.S. interest rates. My expectation is the data in the months ahead will show the U.S. economy to be a lot weaker than most people expect. That will make it clear that there's not going to be a rate increase next year, that we may even see QE4. At that point, the whole seesaw will flip, and then the money will flood out of the United States back into Europe and Japan. It'll be, carry trade back on, stronger yen, stronger euro, weaker dollar, but not right away. I really don't expect to see that until, maybe this time next year.
Okay, so for the sake of time, I'm going to be moving some of these questions around in the queue in terms of priority. We'll try to get to all of them if possible, but we're going to hit some of these in order of priority as well. So this next question is coming from Chinyani M, and his question is, Jim, how do you evaluate gold storage companies, and which countries are the best to store gold in?
Well, gold storage companies, my advice would be, first of all, go with private storage, not bank storage. And the reason is that, of course, the banks are heavily regulated. I'm looking at the potential for asset freezes. I talked earlier about freezing bank accounts and freezing money market accounts. They might try to freeze gold that's in banks, and so if you're in non-bank storage, you have a better chance of surviving that sort of thing. There are some very, very reputable firms out there. I think the advice I would give is the same advice I would give on almost any type of business decision, which is look for a reputation, look for people with long track records, look for people with references, with insurance and bonding. Don't go with the fly-by-night guy who just set up shop. He might be okay, but how do you know, really? Go with the established custodians, and one of the things I like about the physical gold fund is that they store their gold. They offer the storage facility to the customer, and they'll handle all the details. They'll sweat the details, so that's great. But when you say where is the gold actually, it's in Viamat, which is one of the high reputation firms. I mean, they're Viamat, G4S, Brinks, Dunbar. There are a few of them. Physical Gold Fund is with one of those non-bank but high-quality, well-established vaulting companies. So that's what I would recommend. As far as jurisdictions are concerned, you have some trade-offs. My favorite jurisdiction in the world is Switzerland when it comes to gold. Now, we all know what's happened with U.S. citizens opening bank accounts in Switzerland. There's an enormous amount of tax fraud there. I'm not on the side of tax fraudsters, but what has happened as a result of that is that the famous Swiss bank secrecy is pretty much a thing of the past, at least for U.S. customers. If you're if you're a Russian or South American or Chinese and you have a Swiss bank account, you can probably still count Swiss bank secrecy. But if you're a U.S. citizen, no, they're just going to hand over your information. But we're not talking about Swiss bank accounts. We're talking about gold storage. And there, when you look at the rule of law, constitutional protections, candidly military protections, Switzerland has a history of never being successfully invaded by anybody, as long as anyone can remember. We all know it's highly mountainous terrain, and Swiss Army is one of my favorite expressions. Someone said, Switzerland doesn't have an army, Switzerland is an army. In other words, practically every able-bodied man or woman in the country is ready to be a frontline soldier in very, very difficult, in some ways, nuclear bomb-proof terrain. So it's a nice country physically, but that's not enough. There are physically daunting places in the world that don't have good rule of law. But in every dimension, Switzerland checks all the boxes. Now, for U.S. citizens, you might want something, in par closer to home. I think it all depends how much gold you have. If you have, 20, 1-ounce silver coins, that's about, $25,000 worth of gold, give or take. You don't necessarily need to be in a Swiss vault, but if you're looking at larger quantities, if you're looking at 400-ounce bars or kilo bars, I would certainly have a look at Switzerland. Singapore has a lot to offer also, as does Australia, but Australia is pretty cozy with the U.S. Singapore has a lot of the attractions of Switzerland in the sense of being, good rule of law jurisdiction, safe in various ways. but it's in a worse neighborhood. It's pretty close to a lot of political instability in Thailand and Malaysia and elsewhere, and not too far from communist China. So I'm not against Singapore, but I would not, candidly, until recently, I would have said Hong Kong was okay, but of course Hong Kong is obviously coming under the thumb of the communists. So I think my first two choices would be Singapore and Switzerland, and of the two, I have a slight preference for Switzerland.
Okay, very good. Jim M. is asking us, can we please ask Jim to comment on the upcoming Swiss referendum, its likelihood of passage, and the effect on the price of gold?
Sure. So we all know, or I think most of us know, that November 30th there's a referendum in Switzerland, and Switzerland has a few interesting features in its democratic Republican form of government. One is citizens are allowed to petition to get a referendum on the ballot. So it's kind of very similar to California. We've all heard about everything from Proposition 13 to Proposition 42, whatever. Well, same thing in Switzerland. If you get 100,000 signatures, you can get on the ballot. So a group did that, and the Swiss Gold Initiative has a couple provisions. One is that it will require Switzerland to repatriate their gold. In other words, bring their gold back to Switzerland. Right now, most of it's stored abroad. And people say, oh, they're going to have to ship it out of the Federal Reserve Bank of New York. Well, no, Switzerland actually does not have any gold in New York. The Swiss gold is in Canada and London. But be that as it may, the Swiss National Bank would have to call up Canada, to Toronto, and London and get the gold back. So that's the first thing we do. But more importantly, for gold investors, or people holding gold, it would require the Swiss National Bank to back the currency with gold to a certain extent. I believe that's 30%. It's still 20% in one report, but I think it's 30%. But whether it's 20 or 30, the number is higher than the amount of gold they have today. So that would require Switzerland to go out and buy gold. So in addition to repatriating the gold they have, they'd have to go out and buy more gold to meet this requirement of the Swiss National Bank. So that would put a major bid in the market from a very large one. Now we know China's buying gold left and right. Russia's buying all the gold they can. If you put Switzerland in the mix, and Switzerland would be more transparent about it. I mean, China is doing everything by stealth and covert operations and using military and intelligence channels and lying about it. Switzerland, I think we could rely upon to be very transparent. You would know exactly what they're doing. So it has to be bullish for gold in two ways. One, we just put a bid on the market. They'd have to go out and buy this gold. And bear in mind, Switzerland is printing Swiss francs to buy euros. Switzerland was worried about a strong franc, and so they were basically trying to fight the currency wars. They were trying to trash their own currency by pegging to the euro. Well, that meant that as the euro got stronger, you had to go out and, as the Swiss franc got stronger, you had to try to weaken it, and they were doing that by selling francs, buying euros to maintain the peg. Well, that meant that they had to keep printing francs. Well, the more money you print, the more gold you have to buy to maintain the ratio. That's where the referendum and the the currency peg would interact. So, so not only would the Swiss National Bank have to buy more gold to meet the ratio, but if they were trying to maintain the peg at the same time and printing more money, they'd have to keep buying more and more gold because they would be printing more money, creating more assets, and therefore need more gold to meet the ratio all at the same time. So it's a very interesting dynamic. They'd be chasing their own tail because the gold referendum would strengthen the Swiss franc, but the Swiss National Bank wants to weaken the Swiss franc. So you start out with stronger franc, you print more money to trash it, but that would mean you'd have to buy more gold, which would strengthen it. So you really are a dog chasing your tail at that point, but it's very good for gold investors. So now, in terms of what's going on in Switzerland, a very interesting dynamic there. And I've spoken to some of these sponsors, some of the people involved. You're not allowed to advertise on TV. It's you just can't do that. And so the campaigning has been by word of mouth and leaflet and poster and putting up posters in train stations and interestingly on social media, Twitter and Facebook and things like that. So there's a little bit of a a 21st century campaign, but not a lot of television, number one. Number two, there's no real no campaign. You know, in Scotland, we saw the referendum on Scottish independence, and there was a big yes campaign, but there was a big no campaign. I mean, they trotted out the poor queen. She's 80-something, and they had to get her involved, and you got David Cameron and Gordon Brown and all these people running around saying vote no. They put a lot into it, and the no's prevailed, and that referendum did not pass. Now, in Switzerland, there's a yes campaign, but there's not a big no campaign. A little bit of scare tactics and some information. They're telling people, you know, if we have a stronger franc, it's going to kill our chocolate bar exports and ski holidays and all that. And, you know, there's something to that, but there's a benefit from having a stronger currency as well, which is you make yourself a destination for investments. So I see more upside than downside. But there are some scare tactics going on. Interestingly, we're seeing one scare tactic that I haven't seen since the 1960s, which is, oh, gee, if you vote yes and Switzerland has to buy gold, the big winners are going to be the Russians because they're one of the largest gold producers and they have a lot of gold. So vote no because we want to hurt the Russians. Well, that's what they said in the 1960s. And when gold was $35 an ounce under the oil Bretton Woods standard and the private market for gold was 40, 41, and the London gold pool was suppressing the price of gold. This is back in 1968, 69. And some economists said, you know, we really, you know, who are we kidding here? We have to revalue the gold. A lot of people said, no, you can't do that because it'll help the Russians. Of course, they were communist Soviet Union at the time. So it's interesting to see this old 1960s argument about helping the Russians being, you know, dusted off and recycled in the middle of the Swiss referendum. So interesting times. Don't know how it's going to turn out. There's not a lot of polling. The problem with polling, it's really expensive, and the Swiss yes forces are a bit of a ragtag army. They have received some contributions. There are ways to contribute to them legally. But, you know, I just know from my own political activities, polls can easily be $100,000 to do it right. So not so interesting. Not a lot of TV advertising, not a lot of polling. Very hard to know what's going on. I have seen some reports that say that yes may be winning, but I don't know how reliable they are. But it looks like it's going to be close, so watch this space. But all the more reason maybe to position a little gold right now because I think the market, particularly after Scotland, like Scotland has nothing to do with Switzerland. There was a lot of buzz about Scotland. It turned out to be a no, so I think a lot of people are like, well, this will turn out to be no. It's a non-event. And if people are discounting no, and it turns out yes, that could be a shock. So there might be a little surprising for world markets at the end of the month.
Okay, very good. This is a very interesting question. I'm going to paraphrase it because the way it's written, I'm going to paraphrase it so maybe it's a little more easy to understand. But this is coming from Steph T, and the question is, can the Fed collapse? If so, would the IMF bail out the Fed? There's another part to this. So the first question is, can the Fed collapse? If it does, would the IMF bail it out? The second part is there any chance that the IMF would need money from China and Russia? And if it did, would Russia even allow that kind of a thing, and what kind of risk would that create?
Great question, and a pretty sophisticated question. So let me just kind of take those in order. It's funny, you know, when you talk about the Fed collapsing, first of all, the Fed has already collapsed, and let me explain what I mean by that. I come out of a hedge fund background, among other things, and I think of the Fed as like a really bad hedge fund. First of all, the Fed is leveraged about 80 to 1. You know, when you have about $50 billion of capital and you have over $4 trillion of assets, that's 80 to 1 leverage. That's sky-high leverage. You know, Wall Street collapsed in 2008 with 30 to 1 leverage, and here's our central bank with 80 to 1 leverage, number one. Number two, the Fed is insolvent on a mark-to-market basis. That is to say, if you took the assets and repriced them not at historic purchase price but at what they're worth today, it would wipe out the Fed's capital. And you don't have to take it from me. I mean, it's the case, but I've had that conversation with two members of the Federal Open Market Committee, one from the Board of Governors and one of the Regional Reserve Bank presidents. These are private conversations. These are not things that you'll see on Charlie Rose, so to speak. But privately, I kind of, you know, we're friends, and I kind of badge them a little bit, and they admit it. Then they wanted to say, well, you know, one of the FOMC members said, well, I got this person to admit it on the third try, and then the person said, well, central banks don't need capital, and and then the other one, the other FOMC member said something along those lines. So the Fed is highly leveraged. Looks like a bad hedge fund. It's insolvent. So if you said, are they broke today? I would say, yeah, they're already broke. But what does that mean? What does the collapse of the Fed mean? What it really means is that it's a collapse of confidence in the dollar, because the Fed prints dollars, right? So if you make McDonald's hamburgers and nobody wants a McDonald's hamburger, then you might have a corporate collapse. And if you make dollars and nobody wants a dollar, then that's probably my definition of collapse. The other thing is people say, well, gee, the Fed could never go bankrupt because they can just print dollars. But what people don't understand is that a dollar is not an asset to the Fed. It's a liability. A Federal Reserve note is a note. It's a form of debt. So when the Fed prints money, they're just digging themselves a deeper hole, because those are the notes. Those are the things that people have to believe in order for the Fed still to be standing. So the Fed can collapse. It's highly leveraged. It's already insolvent. To me, a collapse would mean a loss of confidence in the dollar, because that's the Fed's main product. And so could it collapse? The answer is yes, it could. But what that means is a collapse of confidence in the dollar, which would pretty quickly lead to hyperinflation. Now, could the IMF bail them out? The answer is yes. In fact, I expect that. Just to kind of do a quick sequence, remember in 1998, when long-term capital management was collapsing, by the way, I was very involved in that. I had a front row seat in that. I talked about that. Roger Lawson talks about it in his book, When Genius Failed. But so I know that case inside out. When long-term capital management was collapsing, the fund was bailed out by Wall Street. There was no federal money. It was not a Fed bailout. The Fed did orchestrate it, but the money came from Wall Street. So in 98, you had a hedge fund bailed out by Wall Street. In 2008, Wall Street was collapsing. It wasn't a hedge fund anymore. It was the Wall Street itself was collapsing, and the Fed bailed them out. So the dynamics of 1998 and 2008 are identical, except that in one case it was Wall Street bailing out a hedge fund. In the second case, it was the central banks bailing out Wall Street. So you notice that each bailout gets bigger than the one before. The next crisis, and maybe if we have a 10-year tempo, maybe it'll be 2018, so we'll go 1998, 2008, 2018, so we have this 10-year tempo. I'm not predicting that, but that'll give you the time frame. It'll be the central banks themselves that need to be bailed out, not the hedge funds, not Wall Street, but the central banks. And the only clean balance sheet left in the world, the only thing bigger than a central bank, is the IMF. The IMF is leveraged about 3 to 1, not 80 to 1, so they've got a lot of headroom. They can print a lot of money. Of course, their money is called, has a funny name, the Special Drawing Right, or SDR. That's their world. It's really world money. They don't call it world money because that's too spooky, but that's what it is. So the IMF will print SDRs to bail out the central banks. So that bailout is possible. Now, the third part of the question was, where's the IMF get their money? Well, they get it two places. One, they can print it, as I just described. They can print SDRs. They don't need anything on the other side of the balance sheet to print SDRs. They can just print them and hand them out. So that's one place. But to the extent they don't do that, to the extent that they want to make loans or extend bailouts without printing SDRs, they do have to get the money from the members. And would China and Russia give them money? Well, China and Russia have already given the money. Since 2009, this was sort of something that was announced at the G20 summit in Pittsburgh in September 2009. I mentioned earlier that there's a G20 leaders summit going on right now as we speak in Australia, and there is, but this is one of a series. And if you go back to September 2009, G20 summit in Pittsburgh, Mike Froman and President Obama cut a deal where we basically agreed to refinance the IMF, come up with $1 trillion for the IMF so they could go bail out everybody else. Well, everyone signed on for a certain amount, and guess what? Everyone, Japan, Netherlands, China, European countries, Spain, everybody kicked in their share except the United States. The United States signed up for $100 billion, and so far we have not funded our share. And this is why Christine Lagarde, Madame Lagarde, the head of the IMF, is so enraged. She threatened the United States last spring, said that we've got until December 31st to pay up, or the IMF will start to go its own way, perhaps without the United States, cozying up to the BRICS and other members. That's a big threat. I think the Congress may call her bluff. This is one of these real inside Washington stories. I mean, I don't expect average everyday investors to follow this stuff. You have to be a kind of a geek like me to be immersed in it. But this will be one of the stories in the lame duck Congress, one of the stories that plays out between now and the end of the year. Will John Boehner and the Senate find a way to slip in the IMF money, the $100 billion, before the end of the year? I think they might. I think they may do it on this war appropriation, because the president wants, I think, several billion, maybe $6 billion. He's got two things going on. He wants some billions to fight the Islamic State, and he wants a few billion to fight Ebola. Those are bills that nobody wants to vote against. So assuming they both pass, what you would try to do is slide this amendment into one of those bills, and the IMF would get their $100 billion. But I can't imagine taxpayers are very happy about it. But short answer is the IMF does need money. They do get it from the members, including Russia and China, and the guys who haven't, the deadbeats right now are the U.S., but they're going to try to slide that by the taxpayers between now and the end of the year.
Okay, and we still have another 11 or 12 questions in the queue, but unfortunately we are out of time. I do want to take a moment and just thank all of our attendees for the questions that were asked. Many of these questions were very smart and sophisticated, so thank you for that. And I will now turn it over to John.
Thank you, Alex, and indeed thank you, Christopher, Jeremy, Daniel, Giuliani, Jim, and all the people who asked questions. We apologize to those of you that we didn't get to today, but we'll be mindful of your questions as we plan the next webinar in this series. So thank you to all of you, and thank you, Jim Rickards. It's been great having you with us here today and sharing all your insights with us. But thank you most of all, of course, to our listeners. Without you, these webinars would not be happening. We very much appreciate you taking the time out to be with us throughout. Most of you have stayed for the whole duration here. And just so you know, you can follow Jim Rickards on Twitter. His handle is @JamesGRickards. And let me remind you that you can find Jim's latest book, The Death of Money, at Amazon or any good bookstore. Get yourself a copy. It's a fascinating read. So thanks, Jim and Alex. Bye-bye for now. And we look forward to joining you for our next webinar in this series. Watch your email for details. Bye-bye. For details. Bye-bye. For details. Bye-bye.